The macro picture is telling you that stocks are going higher. Here are 7 charts that signal more pain for the bears. Hey, I am Luke Downey. I'm going over Alec Young's awesome macro piece over at mapsignals.com. Strap in, get a coffee, because this is an awesome data-driven post. So the first thing we want to cover, what the bears miss, is there's a lot of hand-wringing that's going on about the Fed funds. They're like, when is the Fed going to lower rates? It doesn't matter when, it's the fact that they are. Now, how do we know that? Well, we've got in black the Fed funds rate, which has been held steady. And then you've got in red, this is core PCE. This is a key inflation measure. And if inflation is falling, we know that the course of policy is going to meet that. So it's not a matter of if, it's a matter of when. You can also see that US GDP growth percent has actually been falling as well. These are good things, and this tells us that the Fed is going to be lowering rates sooner than a lot of people believe, and that's bullish. But let's keep going. Here's the other major picture that the bears miss, is that corporate earnings continue to go up. So here we've got the S&P 500 in blue, it's at all-time highs. And then we've got plotted over that the 12-month forward S&P earnings. Now, a lot of people, they got nervous here and said, oh, earnings are falling, they're gonna fall off a cliff. That just wasn't the case. Why? It's because 2 major tailwinds are happening right now. You've got AI and you've got the GLP-1 going on in the healthcare space. So corporate earnings are just fine, and that is bullish for stocks. But now let's get into the macro weeds a little bit and talk about one of the biggest cost inputs for corporations, and that is labor cost. Here we've got them plotted since 1995. Labor costs are actually falling, right? So the cost to pay somebody, it's actually going down, it's not going up. So what does that mean? Well, that tells us that corporate profit margins can actually go up. So here we've plotted out a chart that says when the bottom decile, so labor cost, is decelerating like it is right now, that usually amounts to a 6% change in corporate profit margins. So what does that mean? It's a lot of words. Well, here is the key. One, we know that inflation is falling, and we know that productivity growth is climbing. So here you've got the CPI, right? Inflation, it is falling. What does that do for GDP growth and productivity growth, right? Because that is what is going to ultimately drive earnings. Well, we know when inflation is decelerating, you see a lot more growth at the corporate level. When inflation is rising, which we all experienced a couple of years ago, we know that growth is hampered. So this is a great setup for stocks over the long term. So what does it mean for your portfolio? The first thing we want to do is let's look at all of the sectors and then plot out the forward consensus EPS forecast. So this is telling us which sectors are going to grow the fastest in terms of earnings. Ding, 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 technology is number 1. Number 2 is comm services. It's also up there. You've got healthcare, you've got discretionary, and you've got financials. All 5 of those groups are supposed to beat the market in terms of EPS forecasts. The only one that is negative year on year for expectations is the energy sector. So if you're looking for growth, you want to know where the money's going, it's in these top 5 areas. Now let's look at US equity valuations. People are throwing that, saying, oh, things are so expensive. Well, maybe, but let's go ahead and put a little bit of context on that. So in black, you're looking at the 20-year average, and then in blue, this is telling you the 12-month forward. So there are some areas like small cap 600 that are relatively cheap to history. So we do favor a lot of small cap stocks over at Map Signals. Also, if you look at the S&P 500 equally weighted, it's actually not that bad. It's basically equal. You see S&P 500 value is relatively cheap. The real expensive, if you could call it expensive, would be the S&P 500 growth. That's where a lot of the momentum is, and that's where people are all excited about right now. But let's keep going and look at our sector ranks, and this is what is critical. What we do is we take all of the sectors, we take all of the stocks, and then we plot out a map score. So this is an equal weighted score, and we know that technology, industrials, even energy, believe it or not, financials and discretionary, those are our top 5 groups. Energy, it might be one of those that you're saying, well, how is that even possible? It's because of the specific stocks that we're actually looking at. Doesn't mean that we're looking at the S&P Spider Energy. It's the specific companies that we're focused on. These are the areas that I think are going to be ones that you want to overweight over the year. So listen, if you're still reading about the end of days narratives out there, and they are everywhere, just look, take some of these charts, print them out, put them on your refrigerator, show your bearish friends, give them a hug because they're probably going to need it. You guys hang in there. I will see you next time.